Okay, everybody, our next speaker, Harry Dent. Harry is no stranger to the GoCo group. He's a good friend of ours. Look, Harry has come to Australia so many times I've forgotten. I reckon maybe 50 times he's toured here. He's a bit of a rock star down under, which is absolutely fantastic. But, Harry is a champion in demographics. He's blended demographics with economics, and he's come up with some incredible things he sees before they happen, because he believes that demographics will lead to economic changes, which makes sense. And so, Harry, are you there?
I'm here, Greg. Can everybody hear me?
Everybody can hear you, Harry. Harry, how many times have you come to Australia?
Oh, God. Well, I've come a few other than doing tours for you, but I'd say probably 15 in the last 30 years and more of that in the last 20. So I love Australia. And last time I finally brought my wife. And so yeah, it's my favorite country in the world. If there's reincarnation, I'm going to Australia. I'm either going to be a dog or I'm going to Australia. One of those two things.
Well, we love you coming down here, but of course we always love to have you on live stream because you're a character, you speak your mind, you challenge people, and we love that. Harry, 30 minutes from you. Let's go there, give it to us, and I look forward to the best of Harry Dent, and thank you. Okay,
yeah. Good day, everybody. It's good evening here in the States. The more I study, and I have studied a lot, I really took off 7 or 8 years while I was doing business consulting in the 80s and just studied everything in history. I read like 10 volumes of the history of Western civilization. This was like tens of thousands of pages because I just wanted to really get as good a picture of what happens over time. How does life evolve? What occurs? And the one thing you cannot miss, absolutely cannot miss, is cycles. But there's big cycles and there's small cycles. And what that really always comes down to me, the longer I live and the more I study everything, not just economics, but anything I study, it really everything about life is about the play of opposites. In the economy, it's inflation to deflation, boom to bust. In real life, male and female, okay, we're alike, but we're very different. Success and failure. Let me tell you something. You know what the secret to success is? A guy said this, a speaker said this once, and I love it. He said, success is going enthusiastically from failure to failure. And I'm like, that's genius. That's the play of opposites demonstrated in one sentence. Success cannot happen without failure and vice versa. Because what's so good about failure? When you fail, you really dig in. You're forced to dig in, re-examine everything. What did I do wrong? How can I get out of this mess? Now, when you're doing well and your business is succeeding, your life or love life is succeeding, you just kind of cruise along. Hey, that's fine. That's fun, but it's not great for innovation. I am telling you, no question in my mind. I ask these people I meet all the time, what did you learn the most from? Your successes or your failures? And people usually have to stop for a second, but they almost always say failures. And no question for me. My first failure was, I was interested in economics naturally, So I go into college and stuff, and I'm majoring in economics. Wrong, okay? After the third course, I'm like, this is the most obtuse, vague, theoretical topic I could have chosen. There's nothing solid to grab on here. And I just happened to have a really good finance professor. He died a couple of years ago, but man, I've been friends with him for the rest of his whole life. Dick Nuttall. And boy, he made finance interesting. And so what I did, I said, economics is dull. It doesn't teach me much. I'm not learning much. So I took accounting, which all my father's successful business friends, he was in politics, but he had a lot of successful business friends that donated to the political cause. And they all told me, we wish we'd have taken accounting and finance, So I took that in undergraduate, and then I took marketing and management. What I really, when I realized economics wasn't talking to me, really didn't seem to have much to offer, I ended up saying, okay, well, I'll study business. Well, that was a great mistake because that's how you can understand the economy without understanding business and consumers. How do people operate? What do they buy? Why do they buy? When do they spend the most money? It ends up, that's one of the most predictable things on earth. It took me till 1982 to discover, oh my gosh, we know when people spend money. They enter the workforce at age 20. They grow in their skills and experience and their salaries and wages. And the average person, not everybody, the average person peaks at 46. The whole boom we saw, the greatest boom in history from late 82 into late 2007 was the baby boomers, increasing numbers coming into their peak spending at 46. There was a 46-year lag on the birth index, for crying out loud. How complicated is that? But how powerful was that? I mean, my criticism when I started speaking in the mid to late 80s, mostly to small businesses, because big corporations would have never hired an unknown like me back then. People are like, Harry, you're too optimistic. What's wrong with you? Don't you realize Japan's kicking our ass? That we just came out of 12 years of inflationary recession off and on. We're a has-been country. We're setting sun. Don't you get it? And then, of course, we had the greatest boom in history, and everybody did well, which is something we won't see in the future as much. I'll go into a bit, but the U.S. came back and led that boom. I could see it because we had one of the strongest baby boom generations, okay? And the reason I was looking at the baby boom was because I went from Fortune 100 consulting after Harvard Business School, which was boring because the companies were boring, big but boring, to doing the same strategic and turnaround management for new ventures in California. And they were exciting, but their customers were not the old Bob Hope generation of the past. They were the new baby boomers when they were young and just innovating and starting trends. So by studying the boomers for my new venture clients and some of the new ventures, I was CEO of 6 different companies for extended periods of time, in addition to consulting. I had to study the baby boomers, and that's when I saw, oh my God, a mountain of people, much bigger than the generation before them, the Bob Hope generation, I call it, much bigger than the millennial generation, relatively, even though it's higher numbers of births and all that stuff, but relatively much bigger. This generation is going to create the greatest boom in history, and everybody in America and in Europe is kind of bearish and thinks we don't have a lot of potential, and the future belongs to Japan and Asia, and that is true also. So that's where I come from. I quit economics. That's the best decision I ever made. The boredom tripped me off, and my finance professor got me in the right direction, and I studied everything in business. And again, I worked as in a large corporation for 2 years before Harvard Business School, after college, because I had to do that to get into Harvard Business School. That's the only reason I did it, okay? They said you had to get work experience and get good recommendations to get in Harvard Business School. It's hard, you know. So come out of that, consult the Fortune 100 companies. And I'm thinking, oh my gosh, Bain & Company, super company, still is today. We're consulting to the largest companies in the world in business strategy. And I didn't realize, no, we're in the turnaround management business. The companies that come to Bain & Company and BCG and McKinsey are ones that are in trouble. The ones that are doing fine are just coasting along. But remember what I say, failure fosters change and innovation. Success makes you more complacent and even arrogant at times. Okay, so that's how I kind of got in this. My new venture clients opened me up to a whole new realm of operating, innovation, high growth, appealing to a whole new generation, the baby boomers. And the more I looked in that, the more I discovered, oh my gosh, for the first time in history, literally first time in history, in the early 80s, 1981 was the first time the United States Bureau of Labor did their first survey of consumers from cradle to grave, what they spend. This is golden information that most people still don't know exists, and I didn't know that until I had to do research and trip on it. Know exactly when we earn and spend money. And I can get this information around the world, especially in developed countries. So it allowed me to see, okay, what really drives economy, politics is the least, as long as they're not adverse or evil dictators sort of stuff, okay? It is new generations moving up predictable spending curve as they age and get smarter and have the motivation to earn more, if for no other reason, because their kids need to be raised and sent to good schools and all this sort of stuff. And I used to think it was the same cycle, and on a different cycle. That's a 40-year cycle, by the way. New generations, and this is well known, it's quoted in the Bible, 40-year generation cycles, by the way. 45 years, I found later, technology cycles are on a slightly different clock. New technologies, like TVs and radios. We take that for granted. That was a breakthrough of all time back then. You know how boring life was before TVs and radios, and then the jet engine opened up the world on top of TV, and globalization. That's why globalization is so big and continues to be. And then there's the personal computer, microcomputer revolution. Oh my God, a supercomputer, as Steve Jobs said right at the beginning, 76, in your hands? He said that, and it happened a decade later. And he was the head of that. So technological innovation, 45-year cycles. Gerald mentioned geopolitical cycle. That's another. When the geopolitics are tight, the world kind of clams up. People get fearful. Okay, that's a 35-year cycle. 17 to 18 years, good. 17 to 18 years, not so good. We are frankly in a positive geopolitical cycle just started, but we're in the tail end of a very negative demographic generational cycle of spending. And this is the reason that we have seen what I call monetary meth. Now, that's my latest term, okay? We're living in monetary meth. Ever since the 2008 financial crisis and early 2009, the economy this was the worst downturn we've seen since the Great Depression, and at least relatively on par with 80 to 82. So this was a shock. We got spoiled. And so governments reacted, and what they did was they just said, well, we got to do it. They just printed money. The U.S. government printed $1 trillion right there in 2009, that first year. And you know what? I would have said yes to that. We're in a deep downturn. Yes, you want things to restructure. You want business to get more efficient. You want to knock out zombie companies and unproductive debts. That's a very fruitful thing that economists don't really recognize. Okay, they don't like recession. But you don't want recessions to get crazy and get out of control because they can build on themselves. So that first trillion, yes. After that, monetary meth. We've been living in this whole new world. And I'll tell you what, and I learned this from Dr. Lacey Hunt. If you ever get to listen to him, if you ever hear him talking, listen to this guy. He is a PhD economist, okay? And a damn good one. And he's the guy who first explained money velocity to me way back in, I think, the late 80s or something. He says it shows how productively you're investing money. Money, once you invest it, will only continue to grow if you make profits and continue to reinvest profitably. If it doesn't, it'll take more and more money to create less and less and less. Well, guess what the money velocity's been doing since 1997, right when the bubble started, the first tech bubble, 95 to 2000, okay? Bubbles are always a sign of speculative and unproductive investment and, that sort of stuff, okay? That's when money velocity started to drop like a rock. It is still dropping into 2022. That is the telltale indicator. And bubbles always see this, and bubbles always have the biggest crashes because the investment is so unproductive and because bubbles encourage people to just invest wildly and financial assets go crazy, okay? And that's what we've seen. When they started printing money like crazy in early 2009, people, oh my God, they're going to create inflation. No, we've only seen inflation recently. I'll get to that in a minute. What we saw was financial asset inflation. Financial assets today, I've just been researching this in depth and updating everything, close to $600 trillion. That's the biggest economic number in the world. And if you compare that to global GDP at 94 trillion in 2021, that is 6.4 times GDP. No, does that mean anything? No, not unless you look at history. Historically, 2 times GDP is normal for that. And 3 is as high as it's gotten generally before this. So this is saying we're way out of math. This indicator, money velocity, is telling us it's dropping like a rock, that we're investing money unproductively, and that's going to eventually cause worse and worse investments, harder and harder to pay back the debts you borrow, and that's what causes a major downturn like the 1930s. We have not seen a downturn. Even in the 70s, that was a generational slowdown in spending, okay? And it was inflation, which is bad for markets, but it wasn't the Great Depression. Stocks went down 89%, the Dow, which would be more like the NASDAQ today, 89% in that Great Depression crash, okay? Way more than we've seen, even at the worst so far, okay? So what really drives generational demographic cycles, technology cycles, and what we've seen in recent years, right on prediction. I said back in the 80s, along with Sir John Templeton, he was the only guy as bullish as me. He really had his finger on globalization, and I had my finger on the emerging baby boom around the world. We were the most bullish guys back then, okay? That is over. Now, the technology cycle just peaked in 2020. That's an important cycle. That has peaked as well. The geopolitical cycle's been down for many decade and a half. It is only starting to turn up, so about to be a bright spot, but nowhere there yet. We're in the worst fundamental place in our economy since we've been in the early 80s and in the early 1930s, and really more like the early 1930s. This is why governments have been printing money. They're covering over, hoping the economy will get its mojo back and then come back, and it never does. Now, so what just happened? Here's the most important thing, and chew on this for a minute. So we get COVID after all this. Okay, that's what we need. COVID, the global virus going around, slowing everything down, keeping people from going to work, socializing, blah, blah, spending money. Oh, yuck, 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 yuck. Well, that's when the central banks, particularly the Federal Reserve in the United States, really panicked. Now, listen to this number. I had to check everything twice when I looked at it a couple of years ago. Between fiscal stimulus, which they haven't been doing for a long time, and monetary stimulus, which just simply been accelerating since the 2009 bottom, March 2009, printed $10 trillion in the U.S. alone. In 2 years, that's 46% of GDP. What? People don't know this. That's insanity. That is desperation. And you think, hey, if we were growing at 10% in the best economy, here we are 2 years later, and the economy's going into recession again. After this much stimulus, 10 trillion, 46% of GDP, we're already about to fall back in recession. So now they're looking at, well, now we need stimulus, but no, they have to tighten. Why do they have to tighten? Because they created an unexpected and non-fundamental sharp surge in inflation. Now, they've been printing money since 2009. We already know that. All the gold bugs are always saying, oh, it's going to cause inflation. No, because workforce growth, the real indicator for inflation, and I've got the best inflation indicator in the world, and it says we've been going down since 1980, and we should be at about 1% today, and we'll be somewhere 1-2%, 0 to 2 for as far as you can see. Inflation's dead because workforce entry is slowing around the world. Why workforce entry for inflation? Because it costs a fortune to raise a kid and then incorporate them in the workforce, and the last people are businesses that have to get them an office and training. So we have this spike in inflation, and now it calls their bluff. Now they're forced to tighten. Now, what's Jerome Powell in the United States and central bankers thinking? Hey, economy's been strong. Yeah, inflation's out of control. We can handle this. I am predicting we can't handle this because my real indicator, the spending cycles of generations, the spending wave, says we're still going into the bottom of a downturn in natural spending that started in 2008 and will not turn up until 2024. So this is a time when the fundamentals are still weak, and all we need is something to go wrong, and we could be in a crash faster than governments can counter it, okay? That's the trick, because it is hard to fight central banks when their ethos, starting with Mario Draghi, by the way, he's the first guy that when the crisis happened in 2008-9 in Europe, he said, you want to be a short seller and bet against our countries? I will blow you out of the water. I will print enough money to blow you short sellers out of the water. Well, they've been doing that ever since, okay? This is not sound policy. The way you grow is people learn, they grow up, parents invest in them, they invest in their education, they learn, companies invest in them, they get more productive, they earn more, they spend more. That's how you get a real boom. Technologies emerge, as I said earlier, slightly different cycle. They come in, what is the, how do we live without personal computers, for crying out loud? What can we do today that we couldn't do in the 70s or 60s before that? What did they do before TV and automobile? I mean, these things are mammoth, what technologies do. But technologies emerge slowly in niche markets because they're very expensive. People don't understand them. They're scared of them at first, and they hit the 10% on the S curve and they mushroom. The S curve makes technologies very highly projectable once you hit that 10% point for the rest of their life cycle. And my demographic research makes generational spending very predictable. Again, we don't get into a positive economy on all these cycles, particularly the generational one that's been down the longest and hardest, okay? We don't get there till 2024. And then it's different by country. And then we don't have time. I can throw up the spending wave and projections for any country in the world. Oh, let's see. What's the number one? Let me think about that for a minute. What the hell's the number one country? Oh, it's Australia. It's you guys. A wealthy, affluent country, not quite as affluent in income as the US, but you guys have good demographics. Where does it come from? You're not having more babies than we are. You get the highest quality immigrants. We get Mexicans running, a lot of them illegally across the border. You get high quality Asian immigrants. Higher quantity of immigration than we get in the United States and Europe, and higher quality of immigrants. You have the golden formula. You are one of 5 developed countries, small like Norway and Sweden, and your cousin New Zealand, but you're the strongest. You have the strongest demographic spending trends of any developed country in the world, Australia. So what's your problem? Anybody guess? How's your housing prices? You have the second most overvalued compared to income housing prices in the world, second only to China. And China's real estate bubble is already unraveling, which has to. They're way poorer than us. And you know, some Chinese households have 2 extra homes that are sitting empty because that's how they speculate instead of buying stocks like we do in the US or somewhere else. This is insanity, okay? So China is the biggest real estate bubble in the world. United States has the biggest stock market bubble in the world. And all of these bubbles are going to have to deflate because they weigh on the economy. Money velocity is the telltale sign. If I had to take one indicator that everybody should know about, it's money velocity. And Lacey Hunt's the only economist I see talk about it and explain it properly. The most important single fact, how are we investing in the future and how productively? This is a direct measure. And this is saying we've been going in the wrong direction for a long time. As Gerald said, we almost have to have a major crisis here. We have to wash out a lot of unproductive debts and zombie companies. It's the only way out of this, and we need to do it now for the next generation. I'm a baby boomer. I was born in 1953, probably like many people in this audience, and that 37 to 61 was the rising tide of the baby boom births, the largest generation in history, okay? The millennials are not going to be able to see the fruits of their boom if we don't get rid of all our garbage. And all of this excess is debt and stimulus that's occurred even more unproductive investments and bad debts, okay? So zombie companies and unproductive debts are off the charts, and money velocity is the best single indicator, and it all says look out. So let me just give you the rundown of my forecast, what I see happening. And this is shocking, and people have heard me before, it won't be so shocking, but if you haven't, it's shocking. But to me, it's the only real reality I see after this much overstimulus and after demographic trends in the developed world, not the emerging world, the developed world have peaked almost everywhere except for places, a few places, small places like Australia. Okay, just to go back to the early 2009 stock lows, not that far on, not all the way back to 82, the beginning of the boom. That's all I'm projecting is going to happen. That is not minus 92% from the top of the NASDAQ, 86% for the S&P 500, and for the ASX 200, you lucky bastards, only 58%. Now that sounds bad, but wait until you see everybody else. And of course, the Nikkei's already been destroyed before our eyes and nobody paid attention to it. Their peak was at 40,000. They will never, ever see that again. And I said that right away. Japan was the first developed country to peak in their baby boom demographics and to go down. And they had the debt bubble of the era back then. And they never allowed their debt to deleverage either, just like we're doing. And what has it done? Japan has grown zero ever since. Australia, okay? Real estate, that's where it hits us the most. You guys did not have a real estate bubble crash like the US did. Even Canada didn't as much. So we have about a 50% downside by my very best calculations, and that's just going back to the 2012 lows. So we're not going back far. These are not, oh my gosh, we're going to race all the game. No, this is just going back to 2012 in Australia and the US. Sydney, 50% best expectation, 60% worst case. 60% for real estate to go down, and Sydney, Melbourne, 45%, 55% worst case. Brisbane, a little better, 33% expected, 40% worst case. Adelaide, 30%, 33% worst case. 8-city index in Australia, 45% decline, 50% worst case. That is going to be the biggest shock to Australia. You are going to come out of the next few years, and this downturn would have naturally bottomed in stocks late 2022, the economy 2023, most globally in the developed countries, but they pushed it off. My best estimate, and this is good guessing here, mid 2024 before stocks bottom this time, okay? And they peaked January 4th in the S&P 500, November 22nd on the NASDAQ, our small caps in the US, November 8th, Australia, between, I think, February and April 21st was the last peak. So you're the last to peak, which is a good sign of strength, but it just means you have more to go down, but you don't have as much to go down. So biggest number, oh, Bitcoin, got to talk about Bitcoin. I said Bitcoin might could go to 50 to 100,000, but it is going to go down 95% before it ever booms again. And it's gone from 69 down to 17,800, I think. Already gone down 70%. And my projections, just going back to the last set of lows after many years of an extraordinary boom, just going back to the late 2020 lows, it's going to be down 95% to 3,200. Now, might be a little less than that, whatever. So Bitcoin is going to crash. People are saying Bitcoin is a safe haven. Bitcoin was the biggest bubble. The dot-com stocks and stocks like Amazon were the biggest bubbles in the first tech bubbles and crashed the most. Also 95% Amazon. So that's what we're looking at. Bigger the bubble, the bigger the bust. This is an everything bubble for the first time in history. Before, the first stock bubble was 2000, but real estate didn't bubble until 2006. And real estate bubbled because people got killed in stocks and started speculating in real estate. Everything. Most countries in the developed world, stocks, real estate, bonds, everything are peaking at the same time here. We've seen, just to summarize and end here, what I call the first crash. First crash is important. If it's only 10 or 20%, that's not the first crash off of a bubble. History says 28% minimum, 50% maximum. Well, the NASDAQ went down 35% in this first crash. So I say this bubble is burst. There's very low chance we make a new high in the US. And if we don't there, it's only worse in most other countries, okay? So that's the thing. Huge downside in stocks. The biggest downside we'll see, real estate never goes down as much as stocks, but real estate is financed by mortgages and therefore that leverages it. And real estate is more dear to our hearts. And almost everybody owns real estate and not everybody owns a lot of stocks. So this real estate bubble is going to be the hardest thing to hit Australia out of the whole thing. The United States is going to be whacked all around because we're so heavy in stocks, and stocks is such a big business here. But that's it. This is, and I've been saying this is not new stuff because of COVID. COVID has nothing to do with this. It just was a distraction, and it got the government to print $10 trillion in 2 years. This is going to go as the stupidest thing. You're going to print $10 trillion to fight a short-term virus. It just makes people a little sick and then goes away. The same thing happened in early 1920s, influenza. It hit for a couple years and went away. We have a track record for this too. This was the stupidest thing, but why did central banks do this? Because they've been pumping up the economy nonstop since early 2009. They know how fragile it is, because why would they have to keep stimulating that much, that long, if the economy wasn't dead? They're reviving a corpse. So they know how weak it is. So they got scared and they really went overboard with COVID. And that was their classic mistake. There's no way out of this for me now, okay? This is forcing them to tighten. Once you start tightening, you can't just turn on a dime without looking like, oh my God, the economy's really weak and stuff. It's hard to do that. They won't do that on a dime, very unlikely. I think the die is cast. First wave down, 35%. We bounced, 50% retracement, perfect stock pattern. We're in the third wave now. Here's the last thing to remember. My important number today, 10,565 on the NASDAQ. That's the lead bubble index in the world, in the United States. That is where the first wave bottomed. Once we crash through that, this third wave will be stronger and harder, and it'll be followed with another wave after that over the next couple of years, and we will be in the greatest downturn crash of a lifetime. And all you have to do as investors in businesses, you just hunker down, cut your overheads, cut your costs, get lean and mean now, and you will be one of the people that don't go into companies in your sector. Investors, get out of risk assets just for 1.5 to 2 years. That's a short time to miss some potential gains when the downside, which I described today, and Gerald and a lot of other people on this panel. And by the way, this is the best panel I've been on in many years. So congratulations to GoCo on that. This is the time to worry about the downside. This is not a correction. It's not a drill. Get out of risk assets now. Any real estate you can sell, sell. Certainly if you have a vacation home you don't use that much, okay? Stocks for sure. The more you get out of risk assets, the more you get into liquid. Oh, and where do you put your money? What? And then look at the research. Look at the early 30s. Look at 2008 to 9 crisis. And that's the best comp for this. What was the one asset that went up? High quality U.S. Treasury bonds. And yes, Aussie 30-year, 10, 20, 30-year government bonds as well. I would take the treasuries because the dollar is going to get the biggest boost. The dollar was the safe haven in the last crisis in the late 2008. But the high quality U.S. Treasury bonds, longest term possible, TLTs and ETF, the 20-year average, ZROZ, Z-R-O-Z, 25-year. You can buy 30-year Treasury bonds, the U.S., 30-year Australian. You want the longest bonds because they will be the safe haven, and the longest term duration bonds will appreciate the most in the crisis. And the last thing I'm going to leave you with, because you can't forget this, I'm not telling people to buy these Treasury and Australian bonds forever. It's the safe haven. And I'm going to have to disagree with some people here. It's not gold. Gold did better than other commodities in the last crash, 2009, but it still went down 45%. So gold's not a bad place to be, and I wouldn't mind having some of it, but that's not the safe haven. Treasury bonds, highest quality long-term bonds, including in Australia, are the place to be. And then you get out of those because they have low yields and they will not do well in a boom. Then you get back in stocks, and in Australia, in the whole Southeast Asia, kind of everywhere your part of the world is going to boom the most. Europe will never boom in the next boom like they did before. US will do good, but not as great as in the last boom. You are in the right part of the world. Preserve your money now, and then you reinvest in the best stocks and sectors around mid-2024, and I'll live long enough to give you some better timing on that when we get there. Thanks for being a good audience. Thanks for having me, Greg.